Art, welcome to today's Explainer. So get ready because we've got a really fascinating mystery to unravel today when it comes to market direction. We're going to be digging into a brilliant piece of daily market commentary that breaks down exactly how top-tier traders think when the charts are looking, well, a little murky. Instead of just guessing where the market's headed, we're going to act like detectives. We're breaking down the global calendar piece by piece to figure out exactly what the smart money is doing. Let's get right into it.
Everything today revolves around this single critical question. Will today's US data confirm the recent weakness, or is it going to completely catch everyone off guard and surprise the market? Seriously, every single trade, every little price fluctuation, and honestly, every moment of market anxiety today hinges entirely on this one binary outcome. But, to really understand why everything comes down to this one question, we kind of need to take a step back and look at the whole board. Okay, let's dive into this. Section 1. Scanning the global market, eliminating the noise. So to figure out where the market is actually going, we first have to figure out where it isn't going. Think of this like crossing suspects off a list in a detective investigation. Our primary clue from the commentary is right here. Heading into the early trading hours, there's absolutely no strong directional bias before the US session opens. The market is essentially just floating. But why? I mean, when the global markets open, shouldn't there be some momentum? Well, to understand why the market is basically holding its breath, we really need to look at what's happening around the rest of the world.
Now, what's really interesting about this slide is how we can quickly and systematically just eliminate the rest of the globe as a driving force for today's trend in the US dollar to Japanese yen pair. Look at Japan. They released their final Manufacturing Purchasing Managers Index, or PMI. But historically speaking, that just doesn't drive a major trend. Moving down to Australia, yeah, we see positive inflation data, but that's super localized. It really only affects Australian dollar pairs. Then over in Europe, the PMI data is completely mixed. That might shake up the euro a bit, sure, but it definitely doesn't give us any clear direction for the US dollar or the yen. And Canada? Well, they're on a bank holiday, which literally just means lower liquidity and quiet charts. So by sheer process of elimination, none of these regions have the ammunition to start a major global market trend today.
Which brings us to Section 2, the American Catalyst, the sole survivor. Okay, so with the rest of the world crossed off our list, that leaves us with exactly one place to look for real momentum. The board is clear, all that noise is eliminated, and all eyes shift directly to the upcoming US trading session. Think about it. Out of the entire packed global economic calendar, out of dozens of countries and thousands of data points, there is only one single economic event capable of stepping up and actually changing today's market direction. Literally everything else is just background music. And here it is, the sole crucial event of the day. The ISM, that's the Institute for Supply Management, manufacturing PMI, dropping later in the US session. This right here, this is the heavyweight champion of today's calendar. It is the only release with enough gravity to pull the market out of its current holding pattern and force a definitive trend. But, as always, context is everything. Why does this specific piece of data matter so much right now? Well, to understand today, we have to remember what happened last week. Just 1 week ago, we saw a massive market sell-off that was entirely driven by weaker US dollar expectations. Basically, the market placed a huge bet that the dollar was losing its strength. Fast forward to today, and the market is just frozen. It's sitting there waiting for this manufacturing data to drop. The stakes are incredibly high here because this data will either validate last week's massive sell-off or it could completely blow it out of the water. And that brings us right back to our central hook. On one hand, if the data comes in weak, it confirms that existing narrative of a weakening dollar and the sell-off likely continues. On the other hand, if the data comes in hot, completely surprising a market that has already priced in all this weakness, man, that could trigger a massive volatile reversal. Because this incoming data is going to answer this exact binary question. What should we expect the market to do until that number actually goes public? It's simple. It's going to chop around sideways or maybe retrace a little bit, but it is absolutely not going to commit. Let's move to and see how this builds into Section 3, the power of waiting, mastering market psychology. So we've cracked the technical data, but now we're uncovering a profound psychological lesson, and I want you to really let this sink in. Until that US data drops and actually gives us the answer, forcing trades in a choppy, sideways market is completely unnecessary. Actually, scratch that. It's not just unnecessary, it's a trap. It's your ego demanding action when the environment is clearly demanding patience. When there's no clear directional bias, just clicking buttons to feel like you're doing something, that is for sure the fastest way to lose your capital. And this brilliantly illustrates the core lesson of today's explainer. Look at this. Sometimes the most profitable trade is no trade. It sounds totally counterintuitive, right? I mean, we're conditioned to think that to make money, we have to be actively doing something. But in trading, capital preservation is just as critically important as capital appreciation. Recognizing that the market is waiting and choosing to just wait right along with it is a highly profitable defensive action. So, the crucial point is this stark contrast in mindset. On one side, we have the amateur mentality. Amateurs feel this urgent, almost frantic need to be constantly active. They want to be in the trenches, trading every little blip of noise, basically mistaking busyness for actual productivity. But on the flip side, we see the absolute truth of the profession. Calm, collected professional traders don't get paid for their sheer volume of mouse clicks. No way. They get paid for their immense discipline. They get paid for patiently waiting for that perfect, high-probability setup, like getting a definitive answer from this ISM data, before they ever risk a single dollar. As we wrap up this explainer, I want to leave you with this final vital question to ask yourself the next time you sit down at the charts. When the global calendar is quiet and the market is very clearly waiting for a major catalyst, are you actually trading the data or are you just trading to be busy? Mastering the psychology of the wait really is the ultimate trading edge. Thanks so much for diving into this fascinating market commentary with me today, and I'll catch you on the next one.